Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Andy Schneider, U.S. economist at BNP Paribas, to discuss the economic implications of a united versus a divided government. Andrew, it's great to see you. Welcome to Trade Talks.
Thanks for having me, Jill.
And what states are you most focused on for both the presidential and Senate elections?
Right, so they differ a little bit, but for the presidential election, we effectively start with the key 10 or so swing states that President Trump won in 2016. So we can kind of break those into three groups based on his margin then. So the first group, we have Texas, Georgia, Ohio, and Iowa. The second group is Florida, North Carolina, and Arizona. And then the third group is Pennsylvania, Michigan, and Wisconsin. And more or less, President Trump has to run the table again to win the election, whereas Biden has to effectively hold on to Pennsylvania, Michigan, Wisconsin, although he could win some combination of the others. So the map is a little bit bigger for Biden. And we know too that we could learn the results a bit earlier from the North Carolina, Arizona, and Georgia group. They process ballots about 2 weeks before Election Day, whereas Pennsylvania, Michigan, and Wisconsin, they're not going to be processing mail-in ballots until today. So we think we can get the results a little bit earlier in the former group. Now, in the Senate, it's a bit different, but effectively, we think that the Democrats are going to likely lose Alabama, probably gain Colorado and Arizona. So effectively, they need to win 2 of 7 remaining races. And we think those races are Maine, North Carolina, Georgia, Iowa, Montana, Kansas, and South Carolina. But where they've been polling recently, I think they're most competitive in Maine, North Carolina, and Georgia. So that's where we'll be looking. But one thing to note too in the Senate is that both of the Georgia races, if the candidate doesn't get 50%, then they'll go to runoffs, which could be, well, will be 2 months in the future.
What are the economic implications if we continue to have a contested result or a divided government?
Right, so I think on a contested election, that could translate to some near-term uncertainty, and then will likely be a drag on Q4 growth at the minimum. But contested election aside, I think the differences between a united and divided government are significant, and primarily along the lines of likely fiscal policy. So in a united government with a Biden president, Democratic Senate, Democratic House, we're looking at around 6.5% of GDP of fiscal accommodation over the next 2 years. And in any divided government, whether it's a Trump presidency or a Biden presidency with a GOP Senate and a Democratic House, we're looking at about less than half as much of that. So substantially less fiscal accommodation. That said, I think the larger scope for legislation is under a united government. There's just more generally, there's more legislation that can get done. But that being said, I think in the trade arena, in the foreign policy arena, and in regulation, those will all vary pretty significantly depending on if it's a Biden presidency or if it's a Trump presidency.
Well, the key to this market and also for Main Street is the stimulus. We've certainly injected unprecedented amount of money into the system, and who knows exactly how much more we're going to need to get done. So my question to you is, do government deficits and debt matter? Because at some point, this has to get paid back.
So I think that I'm definitely with you that fiscal stimulus is both key for financial markets and the real economy. And I think that government deficits definitely matter. Government debt, not so much. So on the deficits perspective, I think the way to look at it is less the headline number and more how far the economy and the labor force are away from their potential. So if income and spending and hiring too have a good amount of room to grow before we start hitting those resource limitations, then we have room for bigger deficits. Conversely, if we're running huge deficits year after year after year, then at a certain point, we're likely to hit those resource constraints. But right now, the economy is pretty well below our potential. The unemployment is much higher probably than where the NAIRU is. So net, I think at the moment we likely have a good amount more where we can increase deficits without it being a problem. Now on the US debt front, you could look at debts too as kind of the accumulated deficits from the past that we keep count of. And the US is a currency issuer and a reserve currency issuer at that. So I think there's likely little problem with a bigger stock of debt. And I think the space we have for bigger debt is likely pretty big. And, if there are supply issues, that kind of gets into monetary policy, and probably more likely than not, the Fed will accommodate that.
What about inflation?
So inflation is kind of a mystery right now. And with the Fed kind of letting go of the Phillips curve as its framework for evaluating inflation, it's kind of devoid of a unified theory. So the way we think about inflation is kind of along three axes. You have your cyclical axis, you have your structural axis, and you have your supply side axis. And so on the cyclical side, there's kind of three things that drive inflation for us. That's number one, the output gap, which is again, kind of how far away the economy is from potential. Number two, inflation expectations. And number three, policy, both fiscal and monetary. And when we look at those three things in the future, especially in kind of a blue wave scenario, they do suggest that at least two or three, the output gap is likely to close sooner than later in that scenario. And no matter what, we think we're going to have very accommodative monetary policy, and in a blue wave, more accommodative fiscal policy. So net, that kind of suggests that, or forms some basis that we can have some cyclical upside for inflation. But then when you look at the structural factors, we have trends like globalization, digitization, and income inequality that are difficult to quantify, and could have mixed implications. But net, I think they lean towards more of a disinflationary impact. And then lastly, on the supply side, you can see kind of more easily what the COVID crisis has done on the demand side, but on the supply side, it's a little more under the surface. But we think there's a good possibility that there is some structural damage on the supply side, that we could have some permanent labor losses, some broken supply chains. So these disruptions could potentially lower potential growth and create some upside pressure to prices. So, I think looking ahead and putting that all together, we note that we could have some potentially meaningful cyclical upside to inflation, but we're a long way away from potential still. And we also don't have a great idea of the underlying structural and supply side impact.
So Andy, you've spoken about the Fed and you've spoken about the Treasury. So for the benefit of the audience, explain the difference between the roles of the Fed and Treasury. We know they both have the firepower to support the markets and economy. So how can their policy be impacted by the election and their course of action?
Definitely. So I think Chair Powell laid it out pretty well when he distinguished between the Fed and the Treasury and monetary policy and fiscal policy, where fiscal policy in the Treasury is spending power and the Fed is lending power. Although, truth be told, the Treasury plays a part in monetary policy too. But essentially what the Fed does is it conducts policy by buying existing financial assets, by creating new reserve liabilities. And in doing so, it can kind of determine an array of current and expected interest rates and discount rates, which in turn influence lending decisions, borrowing decisions, and then overall financial conditions too. And that's effectively monetary policy. And now the Treasury does two things. So the first is fiscal policy, and that's just carrying out the legislated spending decisions of Congress. And Powell has called this, the great fiscal power of the United States. And the reason for that is it essentially creates incomes. So, that could be through unemployment benefits, it could be through cash transfers, it could be through infrastructure projects, just through hiring. But the bottom line is that Congress decides how much income to inject into the economy, and then the Treasury carries it out. Now, the second part of the Treasury policy that's kind of more on the monetary policy side is the difference between what Congress legislates and what the IRS collects in taxes. The Treasury issues debt securities, and those debt securities happen to be the main instrument of monetary policy. So, the Fed will inevitably kind of have to account for and react to the Treasury's issuance decisions in its own monetary policy. So kind of stepping back and thinking about how both are going to go about different electoral scenarios. In our view, we think the Fed is committed to staying accommodative, providing support to the economy no matter what. In a scenario where we get more fiscal policy, it'll probably have to do less rather than more. But the main axis of difference, again, is the fiscal policy we get. And in a united government, again, we expect pretty substantial fiscal policy. In a divided government, it's going to be a bit less.
All right, Andy, I have one more question for you. When we talk about the Treasury Secretary pick, this is actually one of the cabinet members that I've heard the most about. We know Biden is one of the most centrist of Democrats, but I've heard Senator Warren's name thrown into the mix, and she's a well-known progressive thinker, and I'm sure that this has financial institutions nervous and on their toes. Do you think the Treasury Secretary pick is going to be just as important as when we talk about another areas of key cabinet member positions?
Definitely. So I think the Treasury Secretary pick is going to be, a key player in the direction of policy, the prioritization of policy, and especially generally in the first 100 days of a potential Biden administration, especially with a Democratic Senate, would be, quite active, likely on the legislative front. So definitely important. And I think a Biden Treasury Secretary pick has to fill a few needs. But I will say on the Warren consideration, the Democrats have some experience with a Massachusetts Senate seat that was lost after in a special election. Then now it would be a Republican governor picking a replacement. So I think Biden would probably weigh some of the risks to the Senate, and they'd probably want to be somewhat conservative on that. So, for example, there could be other trade-offs where there could be a pick like Governor Brainerd at the Fed, and perhaps they could pick her as Treasury Secretary, and then you would have to pick a new Fed governor rather than risk a Senate seat. So, I think that could be another possibility as well.
Interesting. So many chess moves we have to think about here. Andy, appreciate all the insight. Thanks for joining us on Trade Talks.
My pleasure, Jill. Thank you.
You got it. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.